Did you know that the multifamily real estate sector in Canada is seeing significant transactions despite economic uncertainties? Welcome to the Multifamily Real Estate Insights podcast. I am your host, Sandy MacKay. Let's get right to it. In a notable development in Vancouver's real estate market, Openform Properties has acquired the foreclosed Davie and Nicola project for $38.5 million. According to Howard Chai's report on Stories, this project, initially developed by Align Properties, has been under foreclosure since September 2023. The property is located at 1485 Davie Street, just a few blocks from English Bay Beach and Sunset Beach. Align Properties, previously known as Vivagrande Developments, had planned a 21-story tower consisting of 128 strata units and 51 social housing units. Although the rezoning application was submitted in 2017 and the development permit was approved in 2018, the project never entered the construction phase. The property, valued at over $39 million by BC Assessment, as of July 2024, remains occupied by a 51-unit apartment building. The foreclosure proceedings were initiated by Bancorp Financial Services, Inc., due to a default on a mortgage agreement with Align Properties. The Supreme Court of British Columbia confirmed the outstanding debt at more than $37 million. After being listed for sale for over a year and receiving multiple offers, Openform Properties, the real estate division of Open Road Auto Group, successfully purchased the property. The transaction involved Openform Properties securing a first mortgage of $30 million, converting $7.5 million of existing debt into limited partnership units for Bancorp, and covering additional costs such as property transfer tax. Openform plans to fund ongoing costs to obtain rezoning and development entitlements, signaling potential revisions to the project. This acquisition marks the fourth project by Align Properties to face foreclosure and be sold. Previous projects included properties on Robson Street, Cambie Street, and Bailey Street, all of which were sold under similar circumstances. With this latest transaction, all four projects by Align Properties have now been sold, and their corporate website is no longer operational, hinting at potential cessation of operations. In a recent update from the Canada Mortgage and Housing Corporation, or CMHC, there is a new product that could be a game changer for home buyers and investors looking to finance home improvements or new construction. The CMHC Improvement. Mortgage loan insurance offers insured financing options up to 95% of the as-improved value for one- or two-unit owner-occupied properties, and up to 90% for three- or four-unit properties. This is particularly intriguing for those in the multifamily sector who are looking to enhance their properties with lower down payments. The flexibility of this product extends to both small and large-scale improvements, with various advancing options available. For new construction, CMHC requires approval prior to the start or at an early stage of construction. This ensures that lenders maintain control of the building process using insured financing and any equity in the land to facilitate the project's completion. However, it's important to note that condominium construction financing is not permitted under this program. The CMHC Improvement Mortgage Loan Insurance also requires a new home warranty for all new homes, which must be in place in provinces and territories where such programs are available. This is to ensure all constructions adhere to the applicable bylaws and regulations, providing peace of mind for buyers and lenders alike. For those looking at improvement costs, single advances are an option for costs up to 10% of the as-improved value, while progress advances cater to costs exceeding that threshold. For multifamily investors, the loan-to-value ratios are quite favorable. For 1 to 2 unit owner-occupied properties, it is up to 95%, and for 3 to 4 unit properties, up to 90%. For small rental loans, the ratio is capped at 80%. This provides a significant opportunity for those looking to invest in rental properties, allowing for a broader range of financing options and potentially larger projects. Additionally, CMHC has outlined minimum equity requirements, with homeowner loans requiring 5% of the first $500,000 of lending value and 10% of the remainder for 1 to 2 units. For 3 to 4 unit properties, The requirement is 10%. Small rental loans require a minimum equity of 20%. These conditions make it easier for investors to plan their finances and manage their investments effectively. Creditworthiness is another critical factor, with at least one borrower needing a minimum credit score of 600. CMHC is open to considering alternative methods for establishing creditworthiness for those without a traditional credit history. This inclusivity can open doors for new investors and homeowners who are looking to make their mark in the real estate market. Overall, the CMHC Improvement Mortgage Loan Insurance offers a promising avenue for financing multifamily and small rental properties. By providing flexible financing options and favorable loan-to-value ratios, it allows investors and homeowners to realize their property improvement goals with greater financial ease. Whether you're planning a renovation or embarking on new construction, this product could be the key to unlocking your property's potential. Turning our attention to the United States, a significant transaction has taken place in the multifamily sector. Institutional Property Advisors, a division of Marcus & Millichap, has announced the sale of the Venue at Orange, a newly built 328-unit multifamily property in Redlands, California, for an impressive $148.4 million. This equates to approximately $452,439 per unit, highlighting the high demand and value in the multifamily market. Completed in 2023, the Venue at Orange is described as a best-in-class multifamily asset that achieved a swift lease-up, attracting a tenant base with an average annual household income of $135,000. The high quality of life in Redlands, combined with strong demographics and the demand for low-density living, has created favorable conditions for rent growth and low vacancy rates. The sale marks the first high-quality, stabilized multifamily asset to trade hands in the Inland Empire since 2021, according to Kevin Green, IPA Executive Managing Director of Investments. The property's prime location near major retail centers and employers like downtown Redlands, Loma Linda Hospital, and Amazon, coupled with excellent connectivity to major highways and Metrolink stations, makes it an attractive asset for affluent renters. The Venue at Orange comprises 7 three-story buildings with resort-style amenities, including a swimming pool, fitness center, and co-working spaces. The apartments feature modern interiors with 9-foot ceilings, stainless steel appliances, and private balconies, providing a luxurious living experience. The transaction was facilitated by IPA's Chris Zorbas, Kevin Green, Joseph Grabiek, Kyle Pinkala, Alexander Garcia Jr., and Gregory Harris, who represented the seller and developer, Luxview Properties, and procured the buyer, Sentinel Real Estate Corporation. This sale underscores the continuing strength and appeal of the multifamily sector, particularly in regions that offer a high quality of life and robust economic opportunities. And that's a wrap on today's episode. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.